Alrighty, we're looking at the Hamilton Asset Management case study on performance measurement. Question 1, calculate the Sortino ratio for the portfolio delta. So I'm going to pull in that formula right now. Whenever there's a question about a particular formula, it's always good to kind of start writing that out either on the screen or on your scratch paper and just kind of have that formula in the back of your mind so that as you're going through, you can kind of look for the numbers that you need to calculate that. So for the Sortino ratio, we're looking for the return of the portfolio minus the target return, which is going to be RT, and then that's going to be over the the downside deviation. So we'll look for those numbers as we're kind of reading through. Hamilton Asset Management is an investment management firm offering equity and fixed income products to institutional clients. Portfolio Delta is an equity portfolio managed by HAM that focuses on growth stocks across the Asia-Pacific region. Over the last 5 years, Portfolio Delta has delivered an average annual return of 12%. There you go. That's going to be our return of the portfolio with an average volatility as measured by standard deviation of 14%. The downside volatility measured by the target semi-standard deviation is 8%. That'll be our value that goes down here. So we've got two of the three pieces so far. The portfolio management team at HAM follows an active management approach with a target return set at 5% per annum. There's our last figure. The risk-free rate over this period has been consistently at 3%. So we've got those three figures. And we can bring that over here, plug those in. 12 minus 5 over 8 gives us a Sortino ratio of 0.875. And that's it for that question 1. Question 2, discuss the appropriateness of using the Sortino ratio compared to the Sharpe ratio when assessing the performance of Portfolio Delta, considering its investment strategy and the profile of its investors. So let's start reading a little bit more and see if we need any information, but I think everything we've read in paragraph 1 so far will answer our question. Portfolio Delta's investment universe included markets such as Japan, Australia, Hong Kong, Singapore, and New Zealand. The portfolio managers have engaged in both allocation decisions across these markets. There's no more information here. So what we have so far is we're comparing Sortino ratio and Sharpe ratio. So the key differences here is, like we calculated in the last question, the Sortino ratio is a measurement of downside volatility. So when we're measuring downside volatility, in the fund itself has a target semi-standard deviation. So that's indicating that the fund has a emphasis on downside protection. Whereas the Sharpe ratio, we would use our returns and our vol and then our risk-free rate to calculate that. And that's just telling us what are our excess returns over the risk-free rate adjusted for the standard deviation. So essentially, Sharpe gives us overall risk-adjusted returns. Sortino ratio is kind of adjusting that for downside deviation, telling us what our potential downside of the portfolio is. So now that we have those two kind of squared away, discussing the appropriateness of using the Sortino ratio versus Sharpe, I'm going to pull the 3 bullet points I have in here. And when you're answering questions on the test, you can kind of it's always good to kind of bullet them out like this. It can be kind of short, quick bullet points that make your point. So essentially, the fund has a target downside vol. So downside risk is important to Portfolio Delta. Sortino ratio focuses on downside deviation. Sharpe focuses on overall volatility. Therefore, Sortino ratio is the more appropriate measure. So that's all there. 3 quick bullet points gets us to, gives us the information, kind of compares the two, and then that helps us make our decision. Question 3, calculate the allocation and selection effects of the overweight decision with respect to Australia. We left off right here, so let's start reading. Portfolio Delta's investment universe included markets such as Japan, Australia, Hong Kong, Singapore, and New Zealand. Hamilton's portfolio managers have engaged in both allocation decisions across these markets and stock selection within each market. Their relative weighting and performance against the MSCI Pacific benchmark are essential elements of Ham's performance analysis. Ham's portfolio overweighted Australia, which had a 5-year return of 5.1%. That's going to be key for selection effect, and we'll use it for allocation effect potentially in the same sector. Australia's weighting in the portfolio delta was 30% and the benchmark was 25%. So we went overweight Australia, that's a positive, and then we also, so we'll have positive on the allocation, and then we also went, did better than the benchmark. So let's pull in our allocation effect first and walk through that. So we're going to have weight in the portfolio minus weight in the benchmark. That'll give us our figures down here. So we have the 30 minus 25.4 brings us to 4.6. And then we're going to multiply that by the difference in our return versus the benchmark. These two should be flipped. Sorry about that. So it should be portfolio minus benchmark. So 5.1 minus 4.1% gives us gives us 4.6% times 0.1% or times 1%. Gives us a allocation effect of 0.046%. So just something to note here too is it doesn't specify in the reading, but I think for level 3, if you get a calculation on allocation effect and it's not specified, you can assume to use this Brinson-Fockler formula. I think in level 2 we were also using the Brinson-Hood, the BHB formula as well, which doesn't take into account the portfolio return. But if it's not specified, I think for level 3 you can assume to use this model. All right, so then that's the first, that'll be your first point. Second point will be calculating that selection effect. So selection effect is going to be weight in the portfolio times the portfolio return minus benchmark return. So you can see the difference here. We're not taking into account any overweighting relative of the sector relative to benchmark. So we just get that 30% weight multiplied by the excess return over the benchmark gives us an effect of 0.3%. Question 4. Calculate the Sharpe, Treynor, and information ratios for manager A and explain how these ratios help in evaluating manager skill. So I'm going to pull those formulas in right now. Like we mentioned earlier, if you know the formula right off the top, then you can, it's always good to write it out right in the beginning so you have them as you're kind of going through the reading. So we left off here, we're looking at manager A. To compare the performance of their managers, Ham also looks at managers A, B, and C who manage different portfolio segments. The analyzed return of manager A is 9.4% with a standard deviation of 10.83, a beta of 1.2, and active risk of 4%. Manager A's performance is assessed against a global equity benchmark with an annualized return of 9.25%. So it looks like we have all the information we need there. So looking at these, so Sharpe ratio is going to be the return of the portfolio minus risk-free over standard deviation. So also important is to explain how these ratios help in evaluating manager skill. I'm going to go through the evaluation first before we just kind of pull in the numbers for that. So for the Sharpe ratio, this is going to be used to evaluate risk-adjusted returns. It's absolute risk-adjusted returns because it's just measuring how well our portfolio is doing relative to the risk-free rate we could return based on how much risk we're taking on from the standard deviation. So it's essentially just measuring how much an additional return are we getting for any risk we're taking whatsoever above the risk-free rate. So then for the Treynor ratio, we're evaluating excess risk above the risk-free rate, like in the Sharpe ratio, but we're adjusting it for systematic risk taken or beta. So systematic risk is going to be the beta. That's how much market risk essentially we're taking. So these two are going to be pretty similar in the sense that higher beta is usually going to lead to higher standard deviation. But it helps us to give Sharpe gives us a sense of how much risk we're taking and how much return we're getting for that. Treynor tells us how much risk we're taking relative to the market, whereas Sharpe is just kind of our portfolio relative to risk-free rate. And then information ratio, this is going to be a much better measurement in manager skill, because we're taking into account the active bets that we're taking and how we're deviating from the benchmark, and then how that's actually leading to better returns. So in all instances for these, higher number is going to be better. So for information ratio, active return is going to be our return minus the benchmark return. And active risk is going to be tracking error. We're given active risk of 4%. But essentially, you want active return to be higher, and the higher active return is relative to active risk, you have a higher information ratio. So if you're able to take less active risk but still generate a high active return, you're going to have a good information ratio. It tells you how good the manager is essentially at deviating from the benchmark. So let's pull in the numbers and show the calculations. So for Sharpe, portfolio minus the risk-free rate, same in Treynor. Then we're just changing the denominator here. So that's going to bring us to 0.593 for Sharpe ratio, and Treynor ratio is 5.35. Information ratio is that active risk. Like we mentioned, it's going to be our portfolio return minus benchmark return over the active risk taken. This is also called tracking error. Gives us 0.0425. Lot there, but good question. And so just kind of level set here, you'd probably get 1 point for having the formula and calculations, and then another 2 points for kind of explaining these properly.